Most people trying to escape their 9 to 5 with dividend investing are mathematically guaranteed to fail. The guru showed you a flashy screenshot of passive dividend checks, but they hid the actual price tag. To replace a basic $3,000 monthly salary with saved dividends, you don't need a couple of grand in a brokerage account. You need nearly $1 million sitting in cold hard cash. Today we are destroying the myths and running the real math on the 9 to 5 grind versus dividend investing to show you which path actually wins. Think about your current reality. You wake up early, battle traffic, sit at a desk, or stand on your feet for 8 to 10 hours and watch your paycheck get eaten by taxes, rent, and groceries before you even have time to buy a cup of coffee. You are locked in the 9 to 5 grind, trading your limited time on earth for a fixed hourly rate or salary. It is incredibly tempting to look at dividend investing as your immediate escape hatch. But here's the hard truth about passive income that creators won't tell you. If you try to use dividend investing to escape your job too early, you will end up broke, frustrated, and stuck in that exact same job for the next 40 years. We are putting both of these paths head to head to show you exactly how you need to play this game to buy back your freedom. Let's look at the first competitor, the classic 9 to 5 corporate grind. For decades, this was the golden path. You show up, do your job, climb the corporate ladder, get your gold watch at age 65, and retire on a comfortable pension. But if you are in your 20s or 30s today, you already know that this version of the American dream is completely dead. Let's break down the actual physics of why a standard W-2 job alone cannot make you wealthy. First, your earning potential is completely capped. You are trading linear time for linear money. There are only 24 hours in a day, and your company is only going to pay you for a set number of them. Even if you work 80 hours a week, you hit a physical limit of how much you can produce. Second, your income is highly taxed. As we've talked about before, W-2 labor is the most heavily taxed activity on the planet. The government takes their cut first, meaning you are working the first 3 to 4 months of every single year just to pay Uncle Sam. Third, inflation is a silent tax that eats your raises. If you work your ass off all year and get a standard 3% merit raise, but the real world cost of groceries, rent, and insurance went up by 6%, you didn't actually get a raise. You took a 3% cut in terms of purchasing power. So, is the 9 to 5 a total scam? Not quite. Its biggest advantage is predictability. It provides you with a stable, recurring cash flow. But if your plan is to simply save your way to retirement using only your paycheck, the math is actively working against you. Now let's look at the challenger, dividend investing. A dividend is simply a company sharing its profits directly with you. If you own shares of a company like Coca-Cola or Realty Income, they pay you a small cash reward every quarter of the month just for holding their stock. It sounds perfect. You don't have to work. You don't have to sell your shares. The cash just lands into your account. Let's say you want to generate a very modest $3,000 a month in dividend income to cover your basic living expenses like rent, food, and utilities. That is $36,000 a year. A safe, sustainable average dividend yield from high-quality, stable companies is around 4%. If you chase yields higher than that, like those flashy 10 to 12% dividend traps, you are usually buying dying companies that are about to cut their dividend and collapse in stock price. To generate $36,000 a year at a safe 4% yield, do you know how much money you actually need to have invested in the market? $900,000. You need nearly $1 million cash sitting in a brokerage account just to make a basic entry-level wage passively. If you are starting with $1,000 or even $10,000, your monthly dividend check is going to be enough to buy a couple of pizzas. It is not going to pay your rent, it is not going to pay off your car, and it's definitely not going to tell your boss to shove it. So, if the 9 to 5 grind is too slow and the dividend investing requires millions of dollars to start working, how does anyone actually win this game? The answer is that you don't choose one or the other. You use them together in a highly specific coordinated strategy. Your 9 to 5 is not your prison. It is your active capital printer. When you are starting out, your labor is your only high margin asset. You need to use your job to generate as much raw active income as humanly possible. But instead of using that income to fund lifestyle creep, like buying a nicer car, getting a bigger apartment, or buying expensive clothes, you treat your salary as a funding mechanism for your investment machine. You have to take the surplus cash from your job and aggressively buy income producing assets. Let's look at how compounding works over a 15-year window if you execute this correctly. You can grind your job, keep your expenses low, and invest $1,000 a month into a portfolio that yields a total return of 9%, obviously by combining stock growth and dividends. Here's exactly what happens. In year 5, you have around $75,000. Your dividends are paying you a few $100s a month. It doesn't feel like much, but the snowball is forming. In year 10, you are sitting at roughly $193,000. Now your dividends are covering a major bill every single month, like your car payment or your groceries, entirely on autopilot. In year 15, you cross the $378,000 mark. At this stage, the compounding is doing more heavy lifting than your actual monthly contributions. The money that your money is making is starting to outpace the money that you are putting in from the day job. This is exactly how you win. Do not quit your job to invest. You use your job to buy your way out of having to work. Before you run out and start buying dividend stocks, you must avoid the single biggest mistake that ruins beginner investors: yield chasing. When you search for dividend stocks, you will see companies offering massive yields of 10%, 15%, or even 20%. It looks incredibly tempting. You think, if I put my money there, I will reach my goals 3 times faster. But high dividend yields are almost always a warning sign. Often, a company's yield looks high because its stock price has completely crashed due to a failing business model. If a company is losing money, they will eventually cut or completely eliminate their dividend payments to survive. You will lose your passive income and you will lose your initial investment capital as the stock tanks. Focus on high quality dividend growth ETFs, or companies that have not only paid a dividend but increased that dividend every single year for decades. They might only yield 3 to 4% today, but that payout is safe and it will grow over time alongside the actual value of the stocks. At the end of the day, the debate between 9 to 5 grind and dividend investing isn't about choosing a side. It's about building a bridge. Your job is the engine that provides the raw power, and the stock market is the vehicle that carries you to ultimate freedom. The system is designed to keep you trading your time for survival until you are too old to enjoy it. If you want to break out that cycle, you need a highly specific, customized strategy that fits your current income and goals. If you're ready to stop guessing, stop falling for the internet finance myths, and build a concrete, real-world wealth plan with direct guidance, click the link in the description to apply to work one-on-one with me. We will look at your actual income, analyze your expenses, and build a custom blueprint to accelerate your path to true financial independence. Let me know in the comments, are you currently focused more on increasing your active career or income, or are you building up your investment portfolio? Hit that subscribe button if you want real math-based financial truth, and I'll see you in the next video. Peace.